AI bubble. Investors are pouring record amounts of money into artificial intelligence companies, betting that AI will reshape every industry in America, from healthcare to manufacturing to entertainment. Billions of dollars have flowed into chip makers, cloud computing giants, and startups that claim to be building the next big breakthrough. The concern is that many of these valuations are based on future promises rather than current profits. Companies with little revenue are being valued in the tens of billions simply because they mention AI in their pitch decks. History has shown that transformative technologies, like the internet in the late 1990s, often create real value over time, but the early rush of capital can inflate prices far beyond what the technology can deliver in the short run. Stock market bubble. Wall Street has seen valuations climb to levels that make some analysts uneasy, with major indexes like the S&P 500 trading at price-to-earnings ratios well above historical averages. Retail investors, encouraged by apps that make trading feel like a game, have jumped into the market in numbers not seen since the dot-com era. Corporate buybacks and low interest rates for much of the past decade pushed stock prices higher, sometimes disconnected from actual business performance. When confidence outpaces fundamentals, a correction becomes more likely, and the higher the climb, the harder the eventual fall can be for everyday Americans with retirement accounts tied to these markets. Real estate bubble. Home prices across the United States have surged in cities from Austin to Phoenix to Miami, driven by low mortgage rates, limited housing supply, and a wave of buyers competing for the same properties. Many families found themselves priced out of neighborhoods they could have afforded just a few years earlier. Investors, including large firms buying single-family homes in bulk, added even more pressure to an already tight market. The memory of 2008 still lingers for many Americans, when a real estate bubble built on risky lending practices collapsed and triggered a global financial crisis. Today's situation is different in some ways, but the fear of another sharp correction remains part of the national conversation. Crypto bubble. Bitcoin, Ethereum, and thousands of other digital currencies have attracted everyday investors, celebrities, and even major corporations looking for the next big return. Prices have swung wildly, sometimes doubling in weeks, and then crashing just as fast, leaving many people with significant losses. Unlike stocks or real estate, cryptocurrencies often lack any underlying asset or cash flow, which makes their value largely a matter of belief and speculation. Regulatory uncertainty in the United States has added another layer of risk, since lawmakers and agencies like the SEC have struggled to agree on how these assets should even be classified. For many, crypto represents both the promise of financial freedom and one of the clearest examples of speculative excess in modern markets. Meme stock bubble. Companies like GameStop and AMC became household names not because of strong business performance, but because online communities on platforms like Reddit rallied together to buy shares and drive prices skyward. These moves often had little to do with earnings reports or company fundamentals, and everything to do with collective enthusiasm and a desire to challenge big Wall Street hedge funds. Retail traders, many of them young and new to investing, saw massive short-term gains, while others jumped in late and lost money when prices eventually fell back to earth. The meme stock phenomenon showed how social media and online communities can now move markets in ways that traditional financial models never accounted for. Venture capital bubble. Startups across Silicon Valley and beyond raised enormous sums of money throughout the past decade, often reaching billion-dollar valuations before ever turning a profit. Venture capital firms competed aggressively to fund the next unicorn, sometimes overlooking basic business fundamentals in the rush to not miss out on the next big win. This created a culture where growth at any cost was prized over sustainable revenue, leading to spectacular failures alongside genuine success stories. When funding dries up or interest rates rise, these companies often struggle to raise new capital, forcing layoffs, shutdowns, or steep valuation cuts that ripple through the broader tech industry. Government debt bubble. The United States national debt has climbed past levels once considered unthinkable, now measured in the tens of trillions of dollars. Years of deficit spending, tax cuts, Stimulus programs and rising interest payments have added pressure to the federal budget. Unlike a company or a household, the government can print money and issue new debt, which delays the day of reckoning, but does not eliminate the underlying risk. Economists disagree on exactly when or how this becomes unsustainable, but rising interest costs alone now consume a growing share of the federal budget, leaving less room for other priorities and raising long-term concerns about inflation and economic stability. Everything bubble. Some economists argue that all of these bubbles are not separate events, but symptoms of one larger phenomenon, where years of low interest rates and easy money inflated nearly every asset class at once. Stocks, real estate, crypto, venture-backed startups, and government debt all grew alongside each other, fueled by the same cheap borrowing conditions. This interconnected inflation means that a serious downturn in one area could quickly spread to the others, since so many investors and institutions are exposed across multiple markets simultaneously. Whether this theory proves accurate or not, it captures a real anxiety shared by many Americans that the financial system as a whole may be more fragile than it appears on the surface.